And good afternoon. Welcome into Market Talk here on this Wednesday, May 18th. Great to have you with us. Thanks for joining us, making us part of your day once again. I'm your host, Jesse Allen. You can find us online by very easily going to markettalkag.com. That is our home on the web, markettalkag.com. And you can find us easily there, all of our streaming sources and much more, all online, markettalkag.com. Well, we have to take a look at these markets here today. It was a rough day across the board, and here to help us make sense of it all, our good friend Mike Zuzolo with Global Commodity Analytics joins us today. Mike, good afternoon to you, sir. I think we coordinated the red because there was a sea of red on that commodity screen today. Really just felt like it stemmed from some of the fears about inflation and Wall Street, and that kind of just really took hold. And once that happened, commodities really didn't have a chance today.
No, that's a really good way to frame it out, Jesse, because we started out this week with several big supply side issues. We had India slam the door on their wheat exports. New Delhi, India this week, earlier in the week, hit new record highs. By Friday, that poor country, parts of it, in key wheat producing areas is going to be 113 degrees Fahrenheit.
Mm-hmm.
So India clearly has a drought on their hands that's affecting their crop negatively. We have the European markets that are seeing a drought on their hands in their largest province or largest state of France. And that's not letting up. In fact, the 10-day outlook is for continued dry weather, and temperatures could start to climb again as we get into the second half of the 10-day outlook on the latest models. And then we had the Mexico news that they were going to cut or completely alleviate or take out import duties on key foods, staples like wheat flour, corn flour, pork, beef. So you had at the beginning of this week, heading into the crop conditions report and the corn planting numbers, a real shock to the market that we have not rationed enough demand because supplies are going down. And it was really felt with the India news because India was going to come in and help Ukraine in those 20 or 25 million tons of lost stocks that we can't get out of Ukraine. And the reason I'm going into this detail, there's a point to it, and I'll get to it here in a second. But then we had the crop conditions report, and we saw the wheat conditions actually drop 2 points to 27% good to excellent. Wheat quality tour confirms USDA's really low yield number from last week. And then finally, we had the corn planting numbers come out. Yeah, we made great progress, got almost to 50%, but we've got 8 out of 18 primary states still less than 45% planted right now. Huge supply issues on the table. And so we come into today's trade and we hear a couple things. One, Russia's got a bunch of wheat. They're going to have a lot more production, a lot more exports. And I sit here and I think to myself, who's going to buy them if they're under economic sanctions? So why would that be such a market mover? And then I got the news that the United Nations and the World Bank and other big organizations are coming in to try and free up the Ukrainian supplies of grains and the Balkan supplies of fertilizer. And I said to myself, well, how are they going to do that when Belarus and Russia are sitting on the fertilizer and economic sanctions are against them? Well, the General Secretary of the United Nations wants to remove the economic sanctions against those products to alleviate the free flow of those goods again. Well, that's not going to go anywhere, in my opinion. And then you go back to the Ukrainian supplies. They're almost all at the port. They're almost all at the port of Odessa. And Russia has a complete control of the Black Sea and Odessa. And so I'm sitting here thinking to myself, this 60-cent down day and some recovery as we got into the later part of the session just seems to me a big overreaction to 1 or 2 or 3 news stories that you could really shoot some holes through.
Well, Mike, I want to pull up this chart right here on the video screen and talk more about the wheat side here and look more at futures. And you mentioned a lot of great points. We've had this run up the last couple of days, pull back. Maybe we got over our skis a little bit, the trade thought. But I'm curious as we look at all this and we really consider potential global food shortages. To your point, there's a lot of concern out there about this right now.
Yeah, this chart shows you real effectively. And when you think about it, between 2014 and 2016, the index for the world food price from the United Nations FAO, who keep track of that, is 100, and so we're essentially 60% higher than where we were between 2014 and 2016. And you can see the wheat market is the vast majority of why that trade has done that. And you go back in this chart. What's really neat too, Jesse, is you go back to that 2008 time period. Wheat once again was the big driver to the big move up in the world food price. And in 2010 through 2016, wheat was the big driver after the 2012 highs to why the market and food prices went down so dramatically. This is one of the key charts that I'm sharing with you and the viewers to give you an illustration of why I always consider wheat as our primary leader. It's the first that's going to go and make a bottom, and it's going to be the first, I think, to make a high. And so that's where today's price action and this chart come together. Is we got the world leaders' attention, and I'm starting to wonder whether they're going to go back to their old way of food versus fuel and kind of take back the ethanol play and really come out against any kind of supply issues. They're going to try and break down as much as possible, because this is getting critical at this point. We knew it would. We had a really good feeling it would, and it is now. So my point being, if I'm right about the market overreacting, we shouldn't need to take out any other key lows at this point and go through some crucial trend lines that we're dancing on right now in corn and beans especially.
Well, let's talk a little bit more on the corn side here, Mike, and I'll flip charts to the weekly corn continuation chart. And, we look at corn the last couple of days after we got those new numbers in on the acreage, lowering that from USDA. Corn has kind of felt like it's traded a little range bound outside of the big market move we saw with wheat the other day, but really just you look at corn here today down moderately, but walk me through your thoughts in corn. Do you feel like we maybe see some sell signals here?
Yes, we've got three big things here, Jesse. And obviously, the first thing is the blue trend line. That is your more steep trend line that the price action developed after coming into 2022. And so that's the first line of defense for the bull. And as this is a weekly chart, notice where that purple bear is just underneath the current price of, and I did this midday. We closed, I think, around 782 area, but let's just stick with the 780 and 3/4 level. That bear and where it's at, if you go any lower and towards where that bear is, not only do you take out the Feb March highs of this year, but you also go back below the 2021 highs of April, May. So that's point number one. We've got to get back above that trend line by the end of this week, in my opinion, or the purple trend line is in play, going all the way back down to the 710, 7 to 15 level in lead month futures. And remember us talking about the May futures and how I really wanted the July to pick up the steam and pick up the ball and run with it after the May corn went off the board. It's just not done that. And you can see that in this chart very clearly. You're at a 5-6 week low right now after today's trade. The second thing I'll point out to you is, see the green wedge there. If you go back to the lows in 2020, that was an August low, and we made a high in April, May of 2021. Well, look at where the point is on that green wedge, that green triangle, and the purple line starts. Wow, it's August, October of this year or last year, and guess where we're at? We're in April, May right now of the next year. So the cycles and the run-up time that we had back from 20 and 21 low to high is almost identical now. So we're running long in the tooth. This rally has been going on quite some time, and it's matched up with the 2020, 2021 rally. So we are at a point now where we got to feed the bull. Last point is the red, where the red arrow is. That's our oscillator. That's a stochastic oscillator. Helps me kind of develop a momentum and sentiment mindset. It gave a sell signal after this past week's trade. So end of last week, we went into a sell signal, and we're trying to confirm that. That would be our very first sell signal since all the way back in February, March of this year. And it'd be the first clean sell signal since that high back in May of 2021. So I'm really taking this weekly chart at face value. I do not want to see that blue trend line price below. And if we do, then I would bet that my mindset from the earlier point that we should be able to turn around right away, and this market's been overdone with this news, is incorrect, and the analysis has to be looked at that way.
Now let's look at world corn prices here in comparison for the U.S. to everyone else. Walk me through this, because to me it looks like a bit of a a bit of a discount for some anyway.
Yes, this is where you come into South America and why the currencies are so important, because the purple line is Brazilian corn. We're well above that, about $20 a ton. Argentine corn in the green. We know they're probably going to have a really good crop. Brazil, I don't think will, but I think Argentina can. So we see Argentine corn, and we don't have a Ukrainian corn price anymore. You notice that stopped a few weeks back at 280 bucks a ton. We know it's higher than that, but the two numbers to watch are Argentina on the downside. We're almost $40 a ton higher than them now, and then France is the blue. They're already up at $400 a ton. The corn price in France is pricing in a drought right now, and so there again, I don't think our corn price should fall on a weekly basis below that blue trend line because of what we're looking at right here. But it can if the wheat wants to continue to go lower. So that's what I'm trying to connect the dots with these three charts.
Well, Mike, as well, you mentioned planting progress. We talked about that a little bit earlier, and just looking at weather. I mean, the trade overall for corn and beans saw a decent jump this week, but still, I think maybe not as much as some people were expecting. And we got to think about this as well. Those final planting dates are starting to creep up on us on the calendar, also.
Yeah, they really are. And this is not just about spring wheat, not just about corn, but it's also about canola. It's about wheat. And it's about pretty much all the commodities. And that's why I think all the commodities will pretty much trend with one another at this point, Jesse, because continued supply issues in one is a supply issue in the other just by default because of the weather and also because of how tight our supplies are. The spring wheat number was the real eyeball opener to me. When you come in with just 5 states that essentially make up all the spring wheat planting in this country, you come in with the situation where your planting's at 39%. You were at 83% last year at this time. Minnesota's at 5% planted in spring wheat. North Dakota 17% planted. Two of the biggest states out there. And so between the corn and the spring wheat, I still think that we've got supply falling faster than demand just because there's limited supplies to go somewhere else. And we still have quite a big size of livestock industry around the world. So my take is the spring wheat's probably going to be our leader to the upside, and corn will and should willingly follow.
I want to touch on soybeans real briefly as well. We really haven't today. A pretty big new crop sale this morning. There was a little bit for old crop, but a pretty hefty new crop sale to unknown. Soybeans tried their best, but just kind of succumbed to all the risk off pressure today. But what are your thoughts on the soybean complex?
Yeah, exactly right. The pork and bean trade tried to reinvigorate itself. We saw the hogs go positive on the day mid-session. All of a sudden, we saw meal go positive too. So the funds tried to come in and buy the dip. They weren't very successful. Why? It began again because of the point just made about I think all of these commodities in the grains and oil seeds are going to pretty much track with one another. The other thing that hurt the soybeans was the crude oil market going from a 7-week high and then going down to within about $1 of its weekly low, its current weekly low. That took away all the steam from the vegetable oil market. But in fundamental terms, Jesse, we're not healing anything in terms of the vegetable oil market. In fact, with what Mexico did and with some of the Iran is doing and with some of the Southeast Asian countries and their governments, what they're doing, hey, protests are starting. Food riots are starting there. I can give you a list of either farmers or people angry in these developing countries that import food because their prices have over doubled in some cases. So governments have two choices. They either let the price of their goods go up and they don't have as much pressure on their finances, and then they have riots and unrest, social unrest, or they give in and subsidize the food. And they're giving in and subsidizing the food just like they did during Arab Spring back in 2011 going into 2012. So soybean market, I think, will continue to follow the corn and wheat. I would say that it's the first one I want to re-hedge before the end of this month.
You mentioned the pork and bean trade. Let's talk hogs. We've had a couple straight days of really impressive gains. And then, I refresh my quote screen midday there, and it's like, all right, we're going to take this thing green today a little bit. It just seems like there's a lot of great support under this hog market here, at least the last couple of days.
I think so too, and I will blend together the cattle and the hogs because I think they should be blended together at this point. We haven't developed a cash trade in cattle. It sounds as though packers are kind of sticking their nose up in the air. They'll take it if it's $2 lower on the week. That I think is directly related to the hog market and the pork sector feeling a very good time in terms of the retail consumption. While packer margins may be red in pork and green in beef, the demand, the final demand, the consumer is, I think, going after the pork side, and the packers probably making up the margin by the retail prices. And so my take is that the hog sector should have made a bottom at this point in the cutouts, and probably needs to go even a little bit higher, maybe another $10, $20 higher, with the bellies leading. We're getting closer and closer and closer to that BLT seasonal, that bacon, lettuce, tomato seasonal, as we get into tomato season with August. So look for that belly market to find its support, since it's had such a good sell-off. Probably 30, 60 days away, but that should just come in and underpin what we should already be able to develop into a good hog market.
And fats and feeders here, real quick. Just one other point on cattle I want to ask you about. It feels like we maybe chopped around a little bit, but chatter I'm hearing from folks is that they think there is opportunity to go to the upside here if we can get into summer grilling season and find a little more demand out there. Obviously, inflation is a concern there, but what are your thoughts with this cattle market? Do you think we can break out of a little bit of the choppy pattern we've been in?
I do, but I think it's going to take longer than I wanted it to. On the consumer side, I think we're seeing some really nasty numbers from places like Walmart and Target. We're just, these fuel prices being double what they were last year. I think it's probably going to be the worst summer grilling season that we've had in the last 5 or 10 years. I really do. In terms of the beef side of the equation, there's enough pork, and we've got the influenza, the avian influenza, it seems like under control. I think pork and poultry are going to be very effective at the meat counter and at the restaurants at this point, Jesse. I couldn't believe what I had to pay for 6 small shrimp and a 4-ounce sirloin steak the other night when I took my wife out. I just thought this is crazy, and that's why we don't go out that much anymore. And I do end up grilling out, but most of the consumption nowadays is going to be in the restaurants. And so I really don't look real favorable upon the beef side of the equation until we get past the cattle on feed report Friday. If it confirms that the supplies are going down, placements are going down, then we can start looking at that June, July, and especially August time period where supplies finally catch up to the lower demand.
I should ask as well. I know we've touched on a little bit in the conversation, but just the route in the stock market today, down over 1,100 points of the Dow as we're talking. Energy's down as well. You mentioned that, but some of this talk from Fed Chair Powell about inflation. I mean, does this feel like a one-day thing again? Because it seems like we've seen this before. We have a big sell-off, and then we rally back in the stock market.
I don't think so. We talked about this last week in terms of the investment flows maybe leaving equities and going to commodities. I think traders in both asset classes realize this inflation's entrenched. It's entrenched in the energies. Here we are. The SPR is the lowest since 1987 after today's energy data. So I think this energy and food inflation and some of the other supply chain issues are going to keep inflation predominantly high through the summer. And I think asset investors are moving and adjusting as such. And I think they should. If I were an asset manager right now, I'd have probably close to 10% of whatever I did in commodities at this point, at least for the next 60, 90 days.
Mike, great stuff as always. Any final thoughts for us today?
We need a sell signal in the dollar. It's flashing one right now at this point, and the bonds are flashing a buy signal on the weekly chart. That would do a lot of good for the commodities right now from an investor sentiment standpoint, Jesse. So kind of dovetailing in that previous point, if I could get a dollar sell signal, that would probably give the Brazilian currency some strength, the Chinese currency some strength. That would really help us in the commodities as we get into May. As I said with the corn, we've been running this bull pretty hard for pretty long. So watch those chart trend lines. And for me, I'll take them at face value. I won't sell cash, but I'll get some puts in place.
Well, Mike, if producers, they need a little advice with their marketing strategy, I know you have a lot of great analysis. How can they get in touch with you and learn more?
Well, the best way is to go to globalcomresearch.com, globalcom with 2M's research.com, and either sign up for a trial subscription or get the toll-free number off the website, 866-471-2588. Give me a call and tell me what you specifically are looking for, what you specifically need, and I'll see if I can't tailor fit something for your farm or ranch.
Well, we appreciate the time as always. Again, find him globalcomresearch.com. With that, Mike Zuzolo, always good to catch up with you on a Wednesday. We'll have to talk and maybe coordinate shirts next week.
I was going to say, great shirt, Jesse.
Appreciate the time, sir. Have a great week. Thank you.
You too. Thanks, buddy.
Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk. That's going to do it for the show on this Wednesday, May 18th. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.